Hello.
Hello. Hello, Anna, Amy and Ruth. Thank you very much for joining me and joining us all here today. Thank you, Steph, for that introduction. I think we all need to introduce ourselves a little bit, well, at least you guys do. So if you could each give a little bit of an introduction to yourselves and the roles you play within the businesses that you represent and what your businesses do.
Well, first of all, thank you, Guernsey, for hosting us this afternoon and for organising this event, and thank you, Henry, for moderating us, fellow panellists. I'm Ana Haurie. I'm the co-founder and CEO of Respira International. We are an impact-driven carbon finance solutions business. What does that mean? It means that we look to work with developers of nature-based projects, primarily located in the global south. These projects are projects that look to restore or protect nature, so avoided deforestation projects, mangrove restoration projects, cook stoves, afforestation, etc. And we support those projects by becoming or by acting as long-term off-takers, so basically buyers of the carbon credits that those projects generate. Those carbon credits then sit on our balance sheet. We bought them, and then we work with corporates on the other side of the equation who are looking to use carbon credits as one of the tools in their own decarbonisation armory pathways. I say that we are impact-driven because we are really looking to support developers of carbon projects by giving them not only just guaranteed pricing, but we also have profit-sharing arrangements in place with those carbon developers. So that means that because we're buying in the long term, as carbon prices appreciate, then they also get to participate in that price appreciation. So they have their floor price guaranteed. So if markets, fall significantly in value, as they have in the last 18 months, they have their floor price there assured. But then if carbon prices take off, they can also then participate in that through, gross margin revenue sharing arrangements that we have.
So those communities around the world can actually continue to benefit from the carbon projects, carbon initiatives, the investment that you put into them in the future. Very nice. Amy.
Good afternoon. Afternoon, everyone. My name is Amy Lazenby. I work at Close Brothers Asset Management, and we look after high net worth individuals, charities, institutions, and academic institutions. And we launched the socially responsible portfolio investment strategies at Close Brothers at the beginning of 2017. I've been there just nearly 11 years with my colleagues Sam and Ian. We've worked together all throughout that time. But been in the industry 25 years, and it's been a really interesting change. So at the end of the 1990s and beginning of the noughties, a typical sterling-based investor had a portfolio benchmarked to the UK FTSE. So if you had any type of ethical or sustainability leaning, your experience was very, very different from what other investors might have had. But the market has grown significantly in size. The global opportunity is much more accessible, and investors are now able also to look at positive alignment with the advent of the 2015 United Nations Sustainable Development Goals, which have been very widely adopted now. And so it's a whole new story for sustainable investors, and one that has the support of government regulation. So it's been a really interesting journey, but that's me and our clients.
Fabulous. Ruth?
Hi everyone, I'm Ruth Murray. I'm an investment director at Gresham House. Gresham House is an alternative asset manager, manages just under £9 billion worth of assets. Gresham House has set out purposefully to be a sustainability-led investment manager, and we have assets across 5 different key areas. We have public markets, private markets where we've got private equity and VCT funds. And then on the side of the business that I work in, our real asset side, we have a social housing division, a new energy division that does battery storage and renewables. We have a large forestry division. Nearly half of our AUM is actually in forestry. And then we've got the bit of the business that I work in, which is sustainable infrastructure. And essentially what we try and do in our sustainable infrastructure team is find real asset solutions that deliver on societal or environmental objectives, but do so in a way that actually generates really positive returns. So that gives us a really wide universe of businesses to look at. We cover about 6 different thematic areas, and we've got businesses within that for anything from waste management solutions, decarbonisation. We've got a wonderful vertical farming business that delivers resource efficiency that I know you're interested in from the trip that Peter went on to Guernsey. And then, of course, we have nature-based solutions, and that's a big area of focus for me.
So we have a truly expert panel, I think you'll all agree. I'm actually, so my background, I started out as a private client investment manager myself. So I'm particularly interested in this space, Amy, particularly as scarily 26 years ago, we launched, I was sort of on that SRI, as it was called back then, socially responsible investment, sort of on that train, and we launched what we understood back then was the first SRI private client portfolio service. Now, back then, it was all about negative screening and screening out the sinners, if you like, from FTSE 100 or FTSE 250 and onwards. And I'm interested in, number one, how you look at how your investors, your clients, want their investment portfolios to be run. Is it sort of profit as well as impact? Is it profit first and then impact? What are your clients looking for when they work with you guys?
Well, at the outset, we tend to not invest in those companies whose products have a negative impact when used as intended. So that naturally screens out products that do harm. Then the question goes over to the client and is a discussion about the balance between investments that are seeking to achieve the purest positive impact versus those investments which don't have a negative impact, but where the financial returns may be higher. But at the outset, everything we do has a dual purpose. It's about investing in businesses with strong growth trajectories, backed by government regulation and government fiscal support, and we're able to communicate the impact of the investments at a company and portfolio level to clients to increase that level of engagement. But it really ultimately depends on the client. And you do see, particularly with the larger institutional clients, those with perpetual money, those safeguarding assets for the future or for multi-generational clients, multi-generations, they have a particular interest in understanding their responsibility with regards to the environment. And, you know, it's not just something that you can say lightly. In August last year, there was a group of school children aged between, I think, 5 and 22 who successfully took the state of Montana to court because they challenged the state of Montana for their continued investment in fossil fuels, and said it harmed not only their health, but their mental health as well, and their case was upheld. So, you know, it is absolutely a fiscal responsibility by these bigger institutions, but I think it's something that's felt quite deeply as a very important responsibility by those institutions with significant assets.
And investors are actually wanting more, positive impact
Absolutely.
to come out. And that's really interesting, because back in my day, I think most private clients were sort of interested, you know, from that sort of, it was when Jamie Oliver was doing his school meals sort of stuff. Yeah. But the clients that really signed up were trade unions, actually, to our service way back then. Anyway.
So can I jump in?
Yes,
Sorry,
please do, Anna.
Just actually what you just said on Montana just triggered, and maybe, I don't know if we have lawyers in the audience, but didn't a couple of years the Charities Commission go to the High Court to, you know, I think there was a case where they were essentially sort of asking whether they had a fiduciary responsibility
Yes, that's right.
to just seek returns, or whether they also had a fiduciary responsibility to have, you know, impact and sustainability. And I think the decision was that impact was part of their fiduciary responsibilities, and that it wasn't just about returns. But
I think that's absolutely correct, and I think that impacts investors, I think, across the piece, but particularly pension fund investors, because they need to take their fiduciary duty very seriously. It also actually impacts directors on boards as well, and asset managers like myself, because I have to look after the fiduciary duties of my institutional investors as well in the decision making that we have. So I think that decision actually is quite helpful and has sort of peters out into decision making more broadly.
We're going to come off the profits impact discussion for the moment. Anna, I'd like to hear a little bit more. You've already told us a little bit about how your business and the carbon credits and the carbon investing you do benefits communities across the world. But I'd like to hear what role carbon investing should play, maybe in investment portfolios from a fund management perspective, but also corporates and insurance companies in their balance sheets and how they risk manage their own businesses.
Just to take a small step back, I think the overarching thesis and the theme that we've got to keep in mind is climate change.
Yes.
And it's a significant risk that, touches us all, whether, wherever we're based, whether we're in business as private individuals. I mean, I was, listening, for example, that many assets now in homes in California can't be insured because of fire risk. We know that lots of parts of the East Coast are uninsurable now. This is all the impact and the effect of climate change. And it always sort of kind of makes me scratch my head a little bit when, businesses will say, well, that's all great, but what's the business case for investing in climate? Well, I mean, this,
you wouldn't have a business.
You wouldn't have a business. Look at what's happened in Valencia with the floods. I think that's directly attributable now to climate change and increasing of water temperatures, which means that the storms are, anyway, that whole geography behind it. So climate change is the absolute imperative here, and we need to take climate action, and we need to invest in climate action. And where we can get most bang for our buck right now, where we are today, is in nature and nature-based solutions. And most of the nature-based solutions, again, I'm talking about scale and availability for today, for now, are in the global south countries. So in Africa, Latin America, deforestation accounts for something like 10% of global emissions every year. So we need to invest in nature, and that is absolutely the sort of kind of key impact. But we're all feeling the price of carbon. So when investors say, well, what is the investment case or the investment thesis for me to invest in carbon credits? It can be multifold. Well, obviously, the main one is, channeling capital to where it's needed to take climate action so that we can mitigate the effects of climate change. If that's not enough, and it should be enough, increasingly companies have exposure to carbon pricing, whether it's, through compliance, ETS systems, tax. We're going to introduce it now, the CBAM. So, equity investor portfolios are actually subject to carbon pricing that those underlying holdings might be subject to. So by having an investment in carbon credits, you can sort of, hedge the exposure of your portfolios to that carbon pricing. Corporates and corporates are increasingly also going to be subject to, having to decarbonize their own operations, and whether it falls under an ETS or not, they might have to be buying, allowances to compensate or make contributions for their unavoidable emissions. So corporates are also now starting to position themselves by making investments into carbon credits.
And Ruth, I'd like to hear a little bit more about the British Sustainable Infrastructure Fund that you at Gresham House run. And also, going into the nature-based, are there investments beyond the renewables, maybe into biodiversity? And also you do quite a lot in waste management, don't you?
Yeah, sure. So the whole idea behind the British Sustainable Infrastructure Fund, actually, it came from a large institutional investor, a local government pension fund, who wanted to try and find a way to direct its capital in something more sustainable, do something that give more additionality to your typical renewables and some of the other infrastructure type assets that were available in the market. This is sort of back in 2016 plus. And that was where the original idea for BSIF, snazzily named, came from. But in terms of how we take that idea and then actually deliver on an aspiration to do something more than renewables, like I said in the introduction, we try and think about how we can use infrastructure to deliver on societal or environmental outputs, and to do that in a risk mitigated manner, because we are trying to get good returns for our investors, but we're also trying to tap into some of the other motivations that our investors have to invest in these sorts of projects, be that delivering sort of a localism agenda, that came through very much through the levelling up type agenda, although I don't think we can use that. It's got a different brand now, but it's a similar type of thing: create jobs, local jobs for local people, and be part of regeneration more broadly. So beyond renewables, when we've looked at our different thematic areas, we've invested in digital inclusion. So this is providing digital access, fibre connectivity to underserved areas in the UK, which is kind of a key infrastructure in terms of actually enabling economic growth, but also to elevate people on a social level. Within the waste solutions, we look at very much niche waste streams, hard to treat waste streams, or trying to find different things to do with waste. So I've got a wonderful business that I work with that takes commercial and industrial processed waste, pelletizes it and turns it into a replacement for coal. And I pelletize the waste, I was like, just squash it together and there you go. It was a huge industrial operation. So that's an innovative way of using something that would otherwise go to landfill. And then sort of more broadly with nature-based solutions, something that we wanted to invest in because it fits so well with our thematic area, but actually really, really hard to try and find an investable proposition for that allowed us to do it in a risk mitigated way. And actually, one of the issues I know, Anna, that we've talked about is demand and lack of demand for some of these products. And with the UK, with England in particular, and the introduction of biodiversity net gain requirements within the planning regime, we were able to create what we considered to be an infrastructure type asset class that could serve that market. But it was only because of regulation. We couldn't rely from an investment proposition perspective on people just wanting to do the right thing. There is a reasonable amount of people wanting to do the right thing, but it's very hard to build a business case on that. So that was kind of a key catalyst for us being able to invest in that area and really do something quite different. But it's also taken an asset manager mindset where we are actually really creative in how we approach doing business. So as a team, and part of this is to do with Peter Backman, who runs my team, he's tried to bring in professionals into our team with diverse thought and opinion and experience to give us as asset managers the skill set to do things slightly differently from before. I used to be a lawyer. I'm not a lawyer anymore, but that I've managed to change career into something different, but bring different skill sets. We've got people who've come from finance backgrounds, people who've worked in restructuring and private equity, but all these different mindsets to allow us to do things slightly differently.
And what is the type of your investor? I mean, so you mentioned you had a cornerstone for BSIF. What type of investor was that?
So it was a local government pension scheme, and the vast majority of our investors at the moment are local government pension scheme investors, and we have some private clients and family offices within BSIF as well. And obviously we look at sort of the wider political landscape around access to capital and how we fit into pooling within LGPS and so on. So there continue to be changes in that fundraising environment, and we always have to think about not only delivering assets that are delivering on our strategy about environment and society, but also that are investable by the widest possible investor pool, which sort of gives you two sets of challenges whenever we're trying to deliver on that strategy.
Anna, what are the type of investors that generally invest in the Respira carbon funds across the board? Because obviously you're also running carbon funds for corporates, but what are the interests?
So we've got broadly two types of investors. One, as you say, corporates. So where we're finding the real demand at the moment is coming from corporates who essentially want to access secure supply of carbon credits for the future, because many corporates now have their own reporting requirements, which like the EU has just introduced the corporate social CSRD, anyway, too many acronyms. That means that whether here through the TCFD or the CSRD, but essentially, there's more of an
danger that we have too many acronyms.
We have too many acronyms,
space.
acronym soup. In any event, though, corporates now have to report their own carbon emissions, and they're also setting their own decarbonisation pathways, whether it's a net zero or other types of targets. And one of the ways that they're going to have to meet those targets is through a combination of reducing their own emissions, but also then having to buy carbon credits for the residual emissions that are left. So you're finding corporates who are essentially looking to position themselves ahead of those supply needs in 2030, 2040, because there will be a supply-demand crunch. So that's probably where we're seeing most of our demand right now. But where we need to see much more proactive involvement in this climate sector is from institutional investors. And as you may be aware, the COP that's going on right now, the Conference of the Parties in Baku, is all about the finance COP. So it's how do we mobilize not just public sector finance, but it's about mobilizing private sector finance into climate solutions. And you mentioned the figure of 700 billion, but actually we need to be sort of deploying 10 trillion every year into climate if we're going to meet the Paris goals of 1.5 degrees. But institutional investors are still very much on the sidelines. So within the institutional framework, it's probably mostly foundations, family offices, DFIs, and other types of impact investors. But we need mainstream institutional investors to step up to the plate.
Just to unpack another acronym which you just used, DFI.
Oh, sorry. I try not to use acronyms. What does DFI stand for?
Development
Finance Institutions. Thank you.
So these are the sort of the big quasi-governmental
World Bank,
World Bank,
IFC, International Finance Corporation, EBRD, European Bank for Reconstruction and Development.
Yeah. Amy, in terms of your investors, obviously, I imagine most of your investors are private client investment managers, but you also have some family investors and larger separate mandate institutions,
Yes.
I believe. And when they are looking at this space, are they saying, everything needs to be liquid and listed, or are they able to also invest in sort of the type of funds that Gresham House and Respira and others manage? Are you able to invest in those as well?
Absolutely. It really depends on the objectives of the client and what their goals are and what the sort of wider sustainable angles they're looking to align most closely with, whether it's carbon emissions, whether it's water use, whether it's general sustainability, a general framework for touching the UN goals. But absolutely yes. There's benchmarks typically always tend to be world equity type benchmarks.
Yeah.
So that can provide some restraint as to the type of investment we make. But within that, there is typically a broader framework which we will adopt to align most closely with the principles that the client is looking to identify with and report against. And so if you have, for example, the UN SDGs, each of which have measurable goals, if you have measurable goals, you can more easily measure the impact the portfolio is having. But at the end of the day, what we like to be able to show the client is that this portfolio of investments, $50 million portfolio, if you look at the individual investment holdings in this, the impact of the companies has been to save 9,000 lives. The companies have reused 25% of their water. They have generated 160 megawatt hours of electricity, enough to power 4.5 million homes for a year. And this type of reporting makes it much more easy to understand, more meaningful. And I think in order to attract more sustainable capital, we need to engender that trust. We need to increase transparency, but we also really need to be able to show that the returns match what you can get elsewhere. Because while there are a small number of institutions who have profit as a second line, actually the key driver for many even the very big institutional mandates is really profits first, and then ensuring alignment with their other wider sustainable objectives.
So I was going to ask you a little bit more about that profit and impact. The balance, is it difficult to focus the balance, is it for your clients, or your clients tell you where the balance should be if they are more interested in impact with some profit, or the other way?
It's about what the clients are looking to achieve, and we'll adapt the portfolio accordingly.
Okay. And how have you seen that change over recent years? Has profit become more important over the last couple of years? We've had some tougher markets.
Exactly. I mean, these things aren't necessarily. One can look at the state of the environment and see how the money has flowed out of some of these investments and become somewhat concerned about the future trajectory. But sustainability and investment and decarbonisation is not going away. The economic environment has changed considerably. And while interest rates were zero, there was a fabulous opportunity to have a portfolio that generated extremely good returns, and optically and in reality was very strongly aligned with decarbonisation and impactful investing. But a lot of those assets are what we call longer duration assets, because you're investing cash flows in the future, and they have not performed as well in the environment of rising and higher interest rates. So there has been a shift of capital, but this is a relatively short-term event in the longer scheme of things.
Yeah, well, hopefully with inflation abating and interest rates coming down a bit, maybe not to zero again. But Anna, the sustainable and perhaps in particular nature-based investment, how profitable can they be for investors on that sort of subject?
They can be very profitable. Our sort of first vehicle is currently running on a gross, underline the word gross, IRR of 40%. Wow. So, but that's because we've invested in very high quality projects. I think the nature of our business model, really stands up to, really stands up to time. But when we go out and try to raise capital for the new fund, I wouldn't go out and say, oh, I'm targeting, 25% IRR, because we're investing in emerging markets. And I just don't think, it's sort of kind of realistic to do that. And that's probably one of the challenges that we find is we're investing in nature-based solutions. It is for impact and it is for profit. But because of where a lot of these projects are based, if I'm going again to these institutional investors, and it's not, and I'd love your perspective, because obviously, infrastructure investors do have a lower expectation of returns, and this is sort of quasi-infrastructure without being infrastructure. A lot of investors come at it with a private equity mindset, and they're saying, oh, so you're asking me to, make an investment into, a reforestation project in Gambia, for example, and you're telling me that you're only targeting a 12 to 15% IRR. Like, yeah, and they say, well, it doesn't really pay me to take emerging market risk in those countries for a 12 to 15% IRR. I would expect a 25% IRR, and that's sort of sometimes where some of the tension comes in trying to attract that type of capital.
I think that's actually that's an issue certainly that we have, is you are different things depending on the lens that people look at you through. So we call ourselves infrastructure, but actually then that turns off other people who see infrastructure as really sort of relatively low return and not very imaginative. But for others, they have their designated buckets, and you've got to try and position yourself into the bucket to access capital. So it is quite difficult. We call ourselves infrastructure, but in reality, many of our assets, they have infrastructure-like features, but it's not traditional infrastructure. It's core plus, depending on the features of the individual portfolio company. But it is a real challenge as to how do you present yourself to access capital.
Yeah, I mean, there is no benchmark for waste management business, as far as I'm aware. How do your investors assess or their returns from your funds?
Well, I mean, we've got the sort of in the very basic. We do our our half yearly evaluations and demonstrate where we are in terms of our performance against those. But sort of more broadly, and this actually goes to what Amy was saying about how do we demonstrate the additionality, because people are coming and they're looking for the impact of our portfolio.
So it's that impact reporting as well.
Is a very big part. So each of our businesses will, because we've got such a diverse portfolio, we will have created bespoke KPIs that fit those businesses. So for example, with Fisher Farms, our vertical farming business, we track water usage, because we're trying to say that we use 95% less water than traditional farming methods. So we track that. We track within our care home portfolio the number of new beds that we provide. Within my biodiversity net gain business, how many hectares of biodiversity we're creating, and we're reporting these KPIs on sort of that broader level back up to our investors. But many of them, actually to your point, want sort of more bespoke reporting to help fit in with how they see the world or what's important to them. We have a big investor in one of our co-invest vehicles. So I spent yesterday going through our response to their sustainability report, and they want to understand, well, what are we doing about diversity? What are we doing about advancing our net zero strategies within our portfolio company? So evolving our reporting to make sure that we're achieving the impact aspirations of our clients together with the returns aspiration is a big part of our day job as well.
Amy, how do you see reporting? What kind of reporting do you require from the corporates that you invest in, but also the funds, the specialist niche funds that the likes of Ruth and Anna are offering to the market? And I mean, I guess from that, how can we scale more capital into those sort of high impact funds as well? There's a couple of questions there.
About 6 questions in one. So a few things. First of all, the type of reporting that you're talking about is exactly the type of thing we look for and report to clients. From, for example, the listed equities, one of the problems that was mentioned previously is how you fit that within a benchmark. So if the client is providing an equity-like benchmark to perform against, it has to be about performance alongside the reporting of impact. And that has come into more prominence in the last few years, given the state of the markets. And what you were saying about the carbon and all the IRRs and what people are looking to get, one of the questions and pushbacks we might get would be about the longevity of performance for this type of asset class, to understand the risks. If the fire burns down the forest, the different carbon impact of different types of trees, how quickly the trees grow, what happens when they stop, what is the life when they take the carbon out of the atmosphere, when do they stop that, how is it managed? And it's a relatively new asset class for investors to be comfortable with. Absolutely get the strong impact point, and this is a challenge, because this is something we'd love to invest more in, but it really depends on how much the client is willing to look at these areas. But when you have the task force in the nature of financial disclosure and regulatory bodies coming out and providing detailed disclosure guidance and disclosure requirements from companies, that really helps businesses and investors consider nature-based solutions for their portfolios, because they have a set of principles and guidance to follow. And increased regulation and guidance like that will automatically increase flows of investments into those types of areas because of the nature of the transparency reporting framework that is provided. And I think that is a really important way of getting increased investments into this area.
You also touched on something that was really interesting, because these are nascent markets, and within one of my portfolio companies, we're trying to create a nature-based product for corporates to invest in. But there's a whole range of different questions people will have around risk mitigation. So you've got high integrity, what does that mean, and having a sort of a common definition of that. But the insurance market's got a huge responsibility to actually start providing products that will sit around some of these solutions. I think there are some carbon products, that help people hedge against forward purchasing carbon credits. But we need it with nature as well, and sort of parametric insurance that takes us beyond, you know, what happens if the tree burns down, because actually that's a sort of quite an extreme event compared to, you know, what happens if actually the progress of your biodiversity creation is slowed, or, you know, it doesn't quite hit the standard you need. So you know, we need more professionals to be giving solutions to help facilitate that marketplace.
This is a brilliant segue. Yes, please. Sorry, Anna.
We're not letting you be moderator, are you? You did say you wanted us to chat. And the insurance market has already started coming up with those solutions, including parametric. So you've got, you know, through a few groups like OCA and Kita, and anyways, some insurance groups where they are providing the sort of insurance for pre-issuance projects and then post-issuance projects, which covers any sort of risk of reversal, which could be through fires or other disastrous effects, or fraud, or negligence, or political risk. So absolutely, it is the advent of those products, I think, which are making this a more sort of institutional.
But this is also, you know, you've sort of touched on their regulatory reporting, what companies need to report, but also, you know, the commercial pull of insurance companies, for example, you know, needing to have these risks mitigated, you know, fire, etc. This brings us nicely onto government push, or, you know, corporate pull, private sector pull. How do you see things? Does government need to create legislation to ensure that companies or investment, etc., are put into what is a climate emergency? How is that the way this market needs to develop, or is it, you know, it should all be on the private sector? Anna.
So I'm a libertarian at heart, so that's kind of, you know, as little government intervention as possible. However, having said that, you know, at least in carbon markets, the private market players in this sector are actually screaming for regulation. We need regulation. We need to make this mandatory. This shouldn't be voluntary. This needs to be mandatory, and I think that is what is required in order to really sort of kind of unlock not only just the demand, but also the capital that's required, because at the moment there is just too much uncertainty there. It's, you know, for investors and for buyers to be able to enter the market. So we need regulation.
And the problem is that uncertainty. In some instances, people will do the right thing, but they're driven by their stakeholders, they're driven by consumer attitude. So it's not something that's going to catalyse the scale of investment that we need and the scale of behaviour change that we need. That said, I think just saying it all has to be regulation doesn't work either, because it'll take too long. So we need to be encouraging people to take early action now rather than just waiting. But, you know, regulation has to be part and parcel of it. So, for example, with our investment in Environment Bank, we wouldn't have been able to make that without having a mandatory marketplace and some demands that we could assess to use as our base case business plan. You know, that's just responsible investing. So I think it is a combination of the two. But I was talking earlier about, you know, the one of the biggest changes to the way in which we approach waste and recycling has come about through the landfill tax, which I think has been one of the most successful taxes to deliver behaviour change. And without that, I don't think we would have the recycling attitude in England that we have. So you can see the positive impacts of legislation in driving behaviour change, and I think that's exactly what we need here.
That's really interesting.
There's a huge fight for capital from the public listed businesses, you know, against or alongside the private businesses as well. So any regulatory support or guidance provided, you know, is really very widely adopted now by lots of different types of institutions. And so, you know, you have a nirvana where you have a very liquid listed business that finds itself in an impactful space, share price performs well, they adopt these regulatory targets, and they can act on them very quickly because they have much more access to capital, they have bigger balance sheets, and they can really change the world more than governments in many respects. and they can announce the push past net zero to real zero, and they can make a significant change by, you know, leveraging renewable energy to create US energy independence, to make energy cheaper, more affordable for consumers, you know, and relay the positive impact that has, you know, by using their renewable energy sources. You can withdraw CO2 emissions from the atmosphere, and, you know,
it is that sort of reducing emissions from anything that they can do. Maybe it's renewable energy, but also working with the likes of Respira and I know you've got some huge blue chip names that everyone will be very aware of, that you work with, that you that come in and help finance the projects that you invest in by buying the credits to offset some of that. And that's in the voluntary space at the moment, but this is what we need, potentially government to just turn the needle to get everyone to do it, I guess.
Yes, that's right, because I think the biggest issue that the voluntary carbon markets suffer from at the moment is, I would say it's reputational risk, because there has been such a negative media campaign against corporates who have used carbon credits, who are taking action. And, you know, they get accused of greenwashing, they get taken to court for greenwashing. And so what corporates need right now is they need the air cover. They need to know that they can, you know, invest safely in these assets and these carbon credits without the risk of being, you know, outed by The Guardian or, you know, taken to court by Climate Action or whoever it might be. So now the easiest thing is to just step away. And the corporates who are still in this sector are, you know, the sort of kind of, they've drunk the Kool-Aid and they're quite thick-skinned, like Microsoft, like Apple, like Netflix. I mean, they're really leading the way, but we need, you know, we need others to step up to the plate. And this is where we need the regulation. This is where we need just the air cover to be able to, I mean, you can buy an allowance in the EU ETS. I mean, what is an allowance? Essentially, it's a permit to pollute, right? That's okay for some reason. But if you buy a voluntary carbon credit, which has actually had a real impact, it has either really reduced an emission out, then that's not okay. That's greenwashing. I mean, there seems to be a little bit of a
disconnect.
A disconnect there. It's exactly the same action. So anyway.
Now, Guernsey has obviously been a very long-term supporter and promoter of sustainable finance and sustainable investment. You know, it's somewhere where a lot of investment companies, investment funds domicile themselves. Obviously, we are here as the sort of Guernsey Finance, Sustainable Finance Summit. I'd like to ask each of you very quickly, in the interest of time, obviously, how you've each worked with Guernsey, and you know, any particular observations that you've sort of had from your experience with Guernsey. Anna, let's start with you.
Oh, I've been working with Guernsey since 2001 when we did on the listed closed-ended investment companies for hedge funds on the London Stock Exchange. I'm a huge fan of Guernsey. My sort of shameless plug is that it is the only offshore jurisdiction that I've ever worked with or will ever work with. They're just, you know, it's just a pleasure doing business in Guernsey. They really sort of kind of facilitate, find solutions. They're very proactive, and you know.
What a wonderful bunch of quotes there.
We haven't been prepared for this at all. No, but the truth is, it's we have colleagues who are based out in Guernsey, and Sam and I go out quite regularly to see our clients and, you know, friends out in Guernsey. But one of the lovely things is that everybody is so nice and open for doing business and just welcoming, which you don't, funnily enough, really get often in London. So that is the biggest difference, as well as the sun shining. But I've been going out to Guernsey for a long number of years because one of my passions and interests has always been this sustainable investing, and it was actually one of the first places that was ever interested in hosting events, you know, surrounded on this topic. So whether it was through the CISI, the Chartered Institute for Securities Investment, or, you know, lately the Guernsey Finance, Sustainable Finance Group, it's been a geography which has invited people to come and speak and talk about this passion. And as you highlighted at the beginning, you know, it's a leader in this area. So that feels a very nice, a good positive and alignment of ideals.
Thank you. Ruth?
Well, our fund, our BSIF funds are all domiciled, and I think for us, and certainly when I talk to my fund controllers, the huge advantage of working with Guernsey is all around reduced administration and actually having a sort of a whole cushion around what we're doing that we can completely trust. You know, I've explained to you some of the assets that we work with, and you know, we're very busy. We've got a lot going on just within managing our portfolio. So knowing that all of that fund control and administration piece is taken care of, I think helps very much us, but also gives an awful lot of confidence to our investors. And then sort of beyond that, you know, just the way in which everything is structured means that it isn't sort of open for public scrutiny what our institutional investors are investing in. There is that privacy, which I think is really, really important actually to a number of our investors whenever they're trying to move into new markets. You know, they are concerned about reputational risk for some of these new areas, but it just gives that level of protection. And then obviously, you know, we've got a whole team of professionals from lawyers to accountants and so on who can actually support based in one area, and that makes it really, really quite straightforward.
Yeah. So finally, it's going to be over to you, but we have had such a fully packed session. We've covered a lot of ground.